And with that said, it's now time to talk all things money with my colleague Rupiwa. Rupiwa, what can we expect today?
Thanks, Dumelo. So it's the rand, which has been described as the most volatile emerging market currency, and it continues to be at the mercy of global and domestic chaos. But it's also feeling the pressure from the ongoing trade dispute between the US and China, which some economists are saying is very bad for South Africa. Joining me now to unpack this is Gary Boyson, Portfolio Manager at Rand Swiss. Gary, many thanks for your time this evening. Earlier in the week, we did see those global catalysts really weighing on the rand. How much of the local chaos are we seeing it's based on its performance in the last 2 days?
It's always very difficult to try and untangle the local versus the international effect on the currency. As you said, the rand is one of the most volatile currencies in the world. It's largely because of the depth and the ability to trade the rand that international investors choose to use the rand as a proxy to essentially try and play that risk-on, risk-off trade-off. So when you get something like the trade war escalating, you see a lot of international investors actually using our currency to try and take a view. If you look at today, we had mining and manufacturing numbers out. Both of them missed expectations, and we did see the rand starting to weaken on the back of that. So we came into the day around 15 rand to the dollar. It did move out to about 15.20 at one point. It's now back to about, again around the 15 rand to the dollar level. So, certainly some of the local factors are playing into the local currency, into the currency. But it's difficult to say. I think if you look at broader emerging market currencies, everything was selling off today. We're certainly moving into that risk-off environment. So I think the majority of this is coming from the trade war.
What does this mean for our inflation outlook? And just talking about what the consumer can expect based on the volatility that the rand's going through.
So often they say it doesn't really matter where the rand is. It's what we want is a more stable rand, because that allows businesses to plan. It allows people to not have to use complex financial instruments to try and just run an average business. But certainly a weaker rand is going to mean a greater cost for imported goods. So anything that you're planning on buying that is not manufactured in South Africa is going to become more expensive, and that's obviously going to import inflation. Certainly it'll have an effect on the CPI. If you look at something as simple as fuel as well. South Africa is an oil importer, so certainly a weaker currency is not going to help in terms of the flow-through effect from higher transport costs that are related to energy prices. Of course, on the flip side, there's always the opportunity as well. So anything that we are manufacturing locally, and while we saw manufacturing contracting in South Africa, a weaker currency should encourage local manufacturers to start to export. So there is a silver lining to it, but certainly not if you're just a consumer.
Another bad thing, though, I'm thinking that we might not see any further interest rate cuts.
Yeah, so certainly a weaker currency, while the SARB does look at the currency as a potential input to inflation, and that does have a bearing on how they see the inflation outlook. You've got to remember that currently we have one of the highest real interest rates in the world. So if you take off where our current interest rate is minus the inflation rate, that number is high given global standards. So even with a weaker currency, I think that we are probably still in for more interest rate cuts locally. Certainly if you look at what's happening overseas, so with the I suppose the escalation of the trade war, with the US announcing that China is now going to be has been labelled as a currency manipulator after Monday, with the additional tariffs that could potentially be coming in on the 1st of September, the extra 10% on $300 billion worth of Chinese goods. That's encouraging the US Federal Reserve to cut interest rates. So if you look at the expectations, we've probably got another at least 50 basis points cut from the Fed. That's going to give our local Reserve Bank a lot of room to maneuver. And I don't think that we're going to see any interest rate hikes in the near future, certainly, even though we have got a weaker currency.
So that's one positive from the trade war perspective when it comes to the SARB. But what are the other implications of this trade war on South Africa at large?
Yeah, certainly. So if you look at it, while you say it's a positive, it's when you get from a market perspective and maybe from a direct consumer perspective, having lower interest rates is great. The price of money is coming down. The problem is the underlying root causes of why the price of money is coming down, and that's because we have very, very weak growth domestically. But what we're starting to see internationally is that we're getting weaker and weaker forecasts for global growth, and this is really because of the increase in tariff barriers across the globe. This is going to at least we're going to start to see the real possibility of a global recession should things play out to their logical conclusion.
Brilliant. Gary, many thanks for those insights. I've been speaking there to Gary Boyson from Rand Swiss.